this is the part that I think is most useful. Of course, talking about trading opportunities is great, but it will benefit you for the time you are talking about it. Okay, you get a second opinion, you're an analyst, or you're a beginner, you're experienced. Everybody enjoys a second opinion. Even people who have spent more than 10 years in the market, we like to have a second opinion. So in the analysis section, that second opinion was provided to you, and in this section I will provide to you something different, because that opinion is good for now, for the current time, for the short term, for today, but the techniques that you will learn are good forever. So this is the part where you get a very good chance to increase your knowledge in the market. So trading techniques, day 5 with fxeducast.com. Thank you very much, fxeducast, for this opportunity to allow me to meet with great people like you guys. Thank you, Jack, for the welcome, and Michael, I can see that you are a fan of Fibonacci. That is great. Of course, Fibonacci and retracement levels in general, not just Fibonacci levels, are great and valuable tools. They can help us understand the reversal points, or the points where the price changes direction sometimes in a magical way. Okay, so guys, welcome, and let us move on with our second segment and last segment for this week, whole week event. Okay, so what is going to be the technique of today for Friday, August 9th, 2019? I will be talking about my MA strategy. Of course, moving averages are used by everybody, and there is, of course, a set of rules on how to use them. The basic strategy is the same for everybody, but you know, every analyst or trader has their own touch of the main strategy, the base strategy that we all use and agree upon. So let me tell you how I myself, in a personal way, use the strategy of the moving averages. First of all, I want you to keep in mind that moving averages are dynamic support and resistance levels. They move up, they move down. When the price moves up, when the market is in uptrend, they move with that in the same direction. When the market is not moving a lot, they are not moving a lot, and they are not much help at that time. But when the market is trending, when you see a trend in the market, moving averages can be extremely helpful in confirming the strength of this trend. That's number one, and in giving you an excellent chances to get in the market at the right time. That is benefit number two. To me, failure at these support or resistance levels is usually an indication of reversal. What do I mean by that? If the price was already above the moving average and it started falling, then if it finds support at this moving average, that could be a very good time to get in on the long side of the market. Okay, of course that will be explained further during this presentation. But just like the reminder I have included in yesterday's technique section, this is exactly the same slide that I included yesterday, and I just copied it to today's presentation. Keep in mind, although sometimes it looks like magic, and you will see that it does, it is support and resistance. It is not magic. We should treat these levels like we treat any other support or resistance, and estimate the chances of them holding or breaking in the same way. So let us start. One more point that we need to pay attention to before we go into the specifics of this technique is the use of confirmation, technical confirmation. What do I mean by technical confirmation? I presented this concept yesterday, and I wanted to talk about it again today. Technical confirmation refers to the situation where several technical tools are pointing in the same direction. Sometimes you are lucky to see technical tools pointing in the same direction or different instruments pointing in the same direction, and that is what every analyst and trader likes to be, and that's the kind of situation that we love. We don't like the situation when we get different readings from different tools. One tool is pointing up, one tool is pointing down, and the other says no decision. That's not the kind of situation to help us make money. Of course, earlier today we have seen a situation with this kind of confirmation when we analyzed the euro, the Swissy, the dollar index, and gold, and all four of them pointed in the same direction. That is a great way to understand technical confirmation. Instruments confirming each other, or technical tools confirming each other. What kind of technical tools we can use to look for this technical confirmation? Of course, now we will be talking about the moving average, but it will help if at the points where this strategy is telling us to get in, we see previous tops and bottoms, we see retracement levels, we see trend lines before the price reaches the level we will be talking about, overbought and oversold readings, and candles in the price behavior after testing these levels that we will be talking about, the use of trend lines after testing these levels, and Elliott wave counts if you are familiar with the wave count process. Okay, so now let us start with the details. Let's talk about the strategy. I'll be talking about the strategy in both the bullish setup and the bearish setup. The bullish setup is the case where the situation on the chart supports a long position, a buy. The exact opposite conditions should apply for the bearish setup, and I will be talking about them as well. And when we have a bearish setup, that is when we will be looking to sell the market, to short the market. So, my own moving average strategy. How do I use it? Okay, first of all, I use the simple moving average, SMA 35, and the simple moving average 49, and I have colored them on this slide just as I colored them on my chart. I'm sure you have seen a moving average that is blue and a moving average that is red on all of my charts, and these are 35 is the red, 35 is the blue one, and the 49 is the red one. And I use, as you have seen, the candlestick charts. Of course, using the bars is also, there's no problem with that, but the visual understanding that the candlestick gives you is way better than the bar. So I highly recommend using a candlestick chart for this strategy. Okay. After a move up, wait for the price to retrace back down to anywhere on means touching, or inside the area between these two MAs. We need to see a move down. So what I want here is I want to see the price already above the moving average, and then I want to see the price move down towards the area between these two moving averages. If we only touch the first of these two moving averages, that's fine. If we go inside the area, that is also fine. Okay, number 3, we need, this is a very important condition, we need a situation where no close below the bottom of the MA area during the current price move is witnessed. So I want to see the price drop towards the moving average area, towards it, touch its top, or fluctuate between these two averages, or even be below this area is okay as long as there is no close. Once we see a close below the bottom of the moving average area, we skip this setup. We don't use it. Okay? Now, if we have all these things, we have a move up and a retracement down, and then the retracement got inside or at the area, and we do not have a close below the bottom of this area, we should wait for one of these 3 situations to happen on the close. And this is Very important, guys. On the close, we don't guess. Before the candle closes, we don't guess. We wait for the time. When the candle closes, it depends, of course, on the time frame you're using. If it's hourly, then you will have to wait for the close of the hour. If it's daily, then you will have to wait for the close of the day, and so on. So we wait for the close. We do not make the decision before the close. On the close of each candle, we wait for something to happen, for one of these three situations to happen. The first thing that we will be looking for is a close above the top of the moving average area. The second would be a green candle. If we see green candle, that's a reason for us to get in. And the third is a bullish candle, even if it was not green. What kind of candles can be bullish and not green? You know, a green candle means that the price is rising during this specific period, but sometimes you don't need a green candle in order to have a bullish opinion on the market. First of all, of course, first thing that comes to mind is the doji. The doji has no body, so it's not green. Another situation is the hammer, and the hammer, of course, is a candle where the lower shadow is very long compared to the size of the body, and the upper shadow 2 to 3 times larger, but it does not have to be in a specific color. A hammer is a hammer, whether it's green or red. If it satisfies the conditions for the lower shadow and the body size, then it's a hammer. It does not have to be green. Okay, a spinning top is also spinning top candles are candles with small, very small bodies and shadows on both ends. If it's red or green, it does not matter. And finally, the candles that have long lower shadows, those are bullish candles, even if they were red. Green, red, it does not matter. The long lower shadow is bullish. These are the situations where we can have candles that are bullish but not green. So, to recap, we need to see either a close above the top of the MA area, moving average area, a green candle, or a bullish candle even if it was not green. One of these three situations. We do not need to see all three of them. We need to see just one of them. If we see any one of these situations after testing the moving average area, what do? We do what point number 5 is telling us: initiate a long position, that is a buy, on the close of the first candle that fits any one of these criteria. Any one. Okay, guys? I need just one. I don't need all three to happen right in front of me in order to have a setup for this strategy. I need one. A close above the top of the MA area, this is one. A green candle, this is one. A bullish candle, even if it was not green, this is one. So I need to see only one of these three. And if I do, I get in the market and have myself a buy. Okay, guys? Now, of course, no matter what kind of strategy you are using, you need a stop. Okay? And because nothing works 100% of the time, keep that in mind. Don't fool yourself. Go look for strategies that work all the time. There is no strategy that works all the time. The good strategies are the ones that can give you an accuracy of 80%, for example. And once again, I've said this before and I say it again. If you have on your hand a strategy that is right 8 times out of 10 and you still can't make money, then you are doing everything wrong. You know. And also, if you are looking for a strategy that is always right and always will give you a winning entry, you are wasting your time, because there is no such thing. It's a myth. Believe me, everybody says that. In the words of my favorite author, Martin J. Prang, there is no holy grail. So there is absolutely no strategy that works 100% of the time. That's why we need to have a stop. Where is the stop for this strategy? Number 6, the stop should be below the bottom of the MA area, the moving average area. And I personally prefer to wait for a close below this area. If the price just drops below it, but when the time for a close comes, it closes inside the area or above the area, I should not close my position. Why should I do that? But if I have a close below the bottom of the area, then I think that the reason to be in this trade is gone, and that's why I want out. And let the stop hit. It's okay. Every once in a while, you will have a bad signal, bad setup from any strategy, no matter how beautiful the strategy you are following. Sometimes it's going to let you down, and it's okay. It is perfectly okay to see your trade get stopped. There's nothing wrong with that. You do not have to make money on every trade. This is the bottom line that you need to learn. Beginners do not listen to that, I assure you. And it's a problem for people who come new to this market. They want to make money on every trade. And if they make money on 6 trades and then a stop is hit, they feel bad as hell. Why? Why? You have made money 6 times and you have lost money 1 time. You need to be very happy about that. You have an amazing performance. That's an accuracy rate of 85.7%. So if you cannot make money overall, winning 6 times and losing 1 or 2 times, then you are doing something extremely wrong. Finally, the limit should be above the previous price top. So, of course, in number 2, we said after a move up, wait for the price to retrace back down. So this move up, the top of this move should be the minimum limit that we should seek. We usually place the limit above the top of the previous move. Of course, there are no guarantees in the market. This is the ideal target. So when this happens, the strategy is working perfectly. But sometimes strategy makes you money and goes in the direction that you are expecting, and you see your trade making money and the pips are counting in your account, the dollars are pouring in, but it does not reach the limit that you are hoping for. Let's say according to the strategy, my limit should be 80, but my position reached a maximum floating profit of 55 pips. What do I do there? Of course, you will be waiting for the limit. That's perfectly normal. But what do we do to protect ourselves in such a situation that we do not turn such a good trade, 50 pips of profit, into a loser? We simply need to do one automatic and simple thing without thinking. Once you have good profit, you move your stop to a small profit. If I get, for example, 40 pips of profit, I place my stop, instead of placing it at the initial level of a loss of 50 pips, I move it to my favor. My trade is now making 40 pips. Either I close it and harvest these gains, or I move the stop to the profit zone and place a stop at, let's say, for example, 10 pips. With this way, if the price continues to the 80 pip limit, that would be great. But if it falls back down hard, I will still be making money on this trade. 10 pips is better than losing. Of course, you agree with that. I hope you agree with that. Nobody likes to lose, even if it's 5 pips. So to protect yourself from such a situation, all you need to know and all you need to do is just move the stop into the profit zone. Okay, guys? Okay, the bearish setup for this strategy is the exact opposite, of course. After a move down, we wait for the price to retrace up and touch or go inside the moving average area. We need to see a move up here. And of course, we need the closing price for every candle within this price move to be inside this area and not above it. If a close happens above the top of the MA area, then we do not use this setup. We skip it and look for other chances later. Okay, if we have this, a move down, then a retracement up, and no close above the moving average area, the top of the moving average area, we look for one of these three situations: a close below the bottom of the area, a red candle, a bearish candle, even if it was not red. Like what? Like doji. We talked about this. Shooting star is the opposite of the hammer. A spinning top, of course, can happen at the bottom or a top, or a long upper shadow. Okay? If we see one of these three, not all three, we initiate a short position. That's a sell on the close of the first candle that fits any one of these criteria. Any one, once again, I want to remind you, we are talking about one of these criteria and not all of them together. Okay? Number 6, we place the stop above the top of the MA area, and of course I prefer the stop to be at a close above the top of the area. If the price trades a little bit above the area, but when the closing time comes, it closes back inside the area or below it, I don't want to get out of this trade. I still believe in it. But if the price closes above the top of the MA area, then I want out. This is the risk that I can handle. I don't want more risk than this, so I'm out and I will be looking for another trade. Okay, the limit in this situation should be below the previous price bottom. Okay, guys, so of course the difference between them is everything is the exact opposite. Instead of above, it's below. Instead of a green candle, it's a red candle. And instead of a long upper shadow, it's a long lower shadow, and so on. Okay, so it's exact opposite. You need to memorize only one of these two setups and implement the exact opposite when it's bearish instead of bullish.